US Treasuries were volatile again overnight, firstly hitting 5% and then yields dived, which dragged on the US dollar and boosted US stocks in late trade. That's coming up in our 5 things in 5 minutes. And then in our bonus deep dive interview, we find out from Mahjabeen Zaman where safe haven investors are putting their money at a time of geopolitical turmoil.
We have seen, like in the last week, for example, is that the Swiss franc had outperformed and has been the key beneficiary of safe haven flows, up around 1% last week, while the dollar was actually down last week.
But first, in 5 and 5 with ANZ. Number 1, the US 10-year bond yield fell sharply overnight after briefly surpassing 5% again. There were reports a big investor had to buy back into bonds to cover a short position. That boosted US stocks and dragged on the US dollar. As we speak at around 5 o'clock Australian time, the S&P 500 is up 0.5%. The New Zealand dollar, that is up at 58.56 US cents, and the Australian dollar at 63.47 US cents. The US 10-year is down 8 basis points at 4.83%, having briefly gone to 5.02% early in US trade. Number 2, the main focus for currency and bond markets through the rest of the day will be PMI figures for Australia, Japan, France, Germany, the UK and the USA for October, so Purchasing Manager Index surveys. I asked ANZ's head of G3 Research, Brian Martin, what we should look out for.
To see if there's signs of economies, particularly in Europe, stabilising. The PMI in Europe has been flagging a downturn in economic activity. And if, as expected, it comes in at 47.4 for October, that would be the 5th month that the PMI has been below 50, signalling a period of below trend, in fact, an economy flirting with recession for the euro area.
Number 3, the other focus in the PMIs is, of course, the United States. Here's Brian again.
We've seen US economic activity way outperform other parts of the world, much stronger than Europe, much stronger than China in recent quarters. So you've had that US exceptionalism. So we will be looking at the PMI data in the United States as well to see what that's saying. The consensus expectation is that it will have eased slightly to 50. So right on the cusp of expansion and softening.
Number 4, Australia's Q3 CPI inflation data is due out tomorrow, and it may cause the RBA some discomfort. That's according to ANZ Senior Economist for Australia, Catherine Birch.
Well, we're expecting that quarterly consumer price inflation is going to re-accelerate. After a slowdown in Q2, we expect the Q3 data to accelerate to 1.1% for the quarter for headline CPI and 1.2% over the quarter for trimmed mean CPI. Now, while that will see the annual measures continue to slow, they're probably not going to slow as much as the RBA would be expecting them to if that data came out in line with our expectations. So that would make the RBA a little bit uncomfortable, particularly given in the recent minutes from the October meeting that they said there's a low tolerance for a slower return of inflation to target than it has currently forecast.
Number 5, within that CPI data, Catherine is expecting some big swings in quite a few categories.
So, for example, we're forecasting a 7.3% increase in petrol, with global oil prices rising sharply during the quarter. Electricity prices are forecast to rise by 4%, reflecting a sharp increase in the regulated retail prices, but this will be partially offset by some state and federal government credits on electricity bills. Tobacco prices are also going to rise again. The government's going to increase the excise duty not only by the usual biannual indexation, but also adding another 5% onto it as part of their strategy to reduce smoking rates in Australia. And rents are also expected to continue to accelerate on an annual basis to almost 8%.
Catherine Birch there. Now it's time for our bonus deep dive interview. I asked ANZ's head of FX research, Mahjabeen Zaman, which currencies are seen as the safest haven, given the conflict in the Middle East may worsen.
When you look at safe haven currencies, you broadly look at Swiss franc, Japanese yen, or the US dollar. While the US dollar has obviously the highest interest rate and possibly from a rate advantage is the most attractive, interestingly, what we have seen like in the last week, for example, is that the Swiss franc had outperformed and has been the key beneficiary of safe haven flows, up around 1% last week, while the dollar was actually down last week. And so with the dollar, while yes, it is a beneficiary of safe haven flows, there's really two-way risk with the dollar going forward. One, obviously, that safe haven story, which we spoke about. The second is obviously US exceptionalism. When is that going to start to fade? Especially last week, we saw Chinese data or the China economy starting to show signs of stabilization. And when we look at the Eurozone, the economic surprise indices kind of point to, bottoming out and improvement there. If we see softer PMIs from the US and improving PMIs from, let's say, Eurozone or the UK, that will have implication for currencies as well.
And if there is more volatility coming out of the Middle East, what are the currencies that are most vulnerable? If people are going into safe havens with the US dollar and the Swiss franc, which are the ones that could really take a hit?
Look, I guess traditionally in a risk-off environment or, pro-cyclical currencies such as the Aussie, Kiwi and CAD tend to sell off, especially if equity markets are softer. However, this is now currently we're also experiencing higher oil prices as well as higher commodity prices. So I think that provides a little bit of an offsetting impact to commodity currencies like the Aussie and Kiwi, which may prevent these currencies from falling significantly more than, let's say, the euro or the sterling, which will be more, I think, would be slightly more impacted if this conflict worsens or deepens.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, October the 24th. Catch you tomorrow with a closer look at the European Central Bank's upcoming decision on Thursday night. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.